The dividend ETF everyone told Harry to buy cost him $100,000, and the one they said was too boring made him that exact amount instead. Here's the thing about dividend investing that took me years to figure out. And when I show you these numbers, you'll understand why 90% of dividend investors are making the same expensive mistake right now. Look at this. JEPI yields 8.42%. DVY yields 3.63%. Any rational person would pick JEPI, right? More than double the yield, double the income. Case closed, except Harry didn't. And that single decision changed his entire retirement savings trajectory. Remember, this is educational content about investment strategy. Always do your own research and consider your personal financial situation before making investment decisions. Here's what we're uncovering today. First, the shocking performance gap that nobody talks about. Then, the hidden metric that predicted it perfectly. And finally, the 3 ETF strategy that could potentially transform your investment portfolio. But before we dive in, let me tell you what happened when Harry walked into my office 6 months ago. Harry had $250,000 to invest. He'd spent months on dividend forums, YouTube channels, everywhere people swore by high-yield strategies. His plan was simple. Dump everything into JEPI for that massive 8.42% yield. Why would I take 3.63% from DVY when I can get more than double? He asked. Fair question, logical even. But here's where the story gets interesting. I pulled up a chart that changed everything. Not a dividend yield chart, not even a price chart. Something else entirely that most investors never check. See, there's this thing happening in financial planning that nobody wants to admit. Everyone's chasing yield like it's 2008. Headlines scream about 8% yields, 10% yields, even higher. But while everyone's focused on today's paycheck, they're missing tomorrow's wealth. The data I'm about to show you proves this mathematically. Pull up JEPI's 6-month performance. Total return, 0.58%. Yes, you read that right. Despite that massive 8.42% yield, the total return over 6 months was barely 0.5%. Now pull up DVY. Total return, 3.99%. The boring dividend ETF with less than half the yield delivered nearly 7 times the total return. But wait, it gets more interesting. JEPI's price actually dropped 3.80% in 6 months. While you were collecting those dividends, your principal was evaporating. DVY? Price increased 2.21%. Your money was growing in 2 ways: dividends and appreciation. This is where most people interrupt and say, but the dividends make up for the price drop. Do they really? Let's do the actual math. Harry's original plan: $250,000 into JEPI. 6 months of dividends at 8.42% annually equals roughly $10,525 in income. Sounds great, right? But his principal after the 3.80% price drop? $240,500. Net position, $251,025. He made $1,025 on $250,000 in 6 months. Now the alternative. Same $250,000 into DVY. Dividends collected at 3.63% annually, $4,537. Principal value after 2.21% appreciation, $255,525. Net position, $260,062. That's $260,062 versus $251,025. A $9,037 difference. In just 6 months. Project that over 5 years with similar performance patterns, and we're talking about a 6-figure gap. But Harry discovered something even more revealing. Here's the pattern nobody's watching. Dividend growth rates. DVY's dividend grew 12.37% this year. Think about that. Your income stream increased by double digits. JEPI's dividend growth over 3 years? Negative. 3.91%. One ETF is raising your income every single year. The other is actually cutting it. Let me put this in perspective. If DVY continues its 12.37% annual dividend growth, in just 6 years, Its yield on your original cost basis would be 7.3%, almost matching JEPI's current yield, but with likely significant principal appreciation on top. This is the wealth-building secret hidden in plain sight. DVY has increased its dividend for 4 consecutive years. It's paid dividends for 21 years. That's 2 decades of consistent payments through recessions, pandemics, and market crashes. JEPI, 0 consecutive years of dividend growth. 4 years total of payments. No track record through different market cycles. But here's something nobody talks about: the silent wealth killer. JEPI's expense ratio, 0.35%. DVY's expense ratio, 0.38%. Pretty similar, right? Wrong. Because there's a third player Harry found. SCHY, Schwab International Dividend ETF. Expense ratio, 0.08%. That's 77% cheaper than JEPI. On a $250,000 investment, that's saving $675 per year in fees alone. Compound that over 20 years, and you're looking at nearly $20,000 in saved fees plus the compound growth on that money. Now here's what shocked me about SCHY. Yield, 3.76%. Not spectacular. 6-month total return, 16.40%. 1-year total return, 11.28%. Wait, what? The International Dividend ETF absolutely crushed everything else? Here's why. While everyone's fighting over US dividend stocks, SCHY quietly owns companies like British American Tobacco at 4.61%, BHP Group at 4.40%, Total Energies at 4.03%. Global diversification with a 3-year dividend growth rate of 34.36% annually. That's not a typo. 34% annual dividend growth. Harry put 1/3 of his portfolio here. Smart move. But Harry didn't stop there. He found VPU, Vanguard Utilities ETF. Now, utilities sound boring. They are boring. That's exactly the point. VPU yields 2.76%. Nothing exciting. But look at the 1-year total return, 14.32%. 20 years of consecutive dividend payments. Utilities are regulated monopolies. They have predictable cash flows. They raise prices with inflation. They're the definition of steady passive income streams. Harry allocated 25% here for stability, because money management isn't just about growth. It's about sleeping well at night. So here's exactly how Harry structured his asset allocation. 40% DVY, the dividend growth champion. 3.63% yield 12.37%. Dividend growth 21 years of payments. Quality holdings like Altria, Ford, Verizon. 35% SCHY, international diversification play. 3.76% yield 34.36%. 3-year dividend growth. 0.08% expense ratio. Global exposure to quality dividend payers. 25% VPU, the stability anchor. 2.76% yield 14.3. 2% 1-year total return. Regulated utility exposure 20 years. Consecutive payments. This portfolio yields about 3.4% combined. Less than half of JEPI's yield. But here's the kicker. The weighted average total return based on recent performance? Over 8% annually. Let's project this out with conservative estimates. Scenario 1. $250,000 in JEPI. Assuming it maintains its recent performance pattern of 0.58% 6-month return. That's roughly 1.2% annually. Add the 8.42% yield, assuming no cuts. Total return around 9.6%, but with declining principal value. Year 5 value, approximately $290,000. Year 10 value, around $340,000. Scenario 2. Harry's 3 ETF portfolio. Conservative 8% total return, below recent actual performance. Year 5 value, $367,000. Year 10 value, $540,000. That's a $200,000 difference by year 10. But it's actually worse for JEPI because we haven't factored in the negative dividend growth. If JEPI's dividend continues declining at negative 3.91% annually, that 8.42% yield becomes 6.8% by year 5. Meanwhile, if DVY maintains even half its current dividend growth rate, its yield on cost would be over 5% by year 5, plus principal appreciation. Here's how to spot the yield trap before it costs you. First warning sign. Check the momentum grade. JEPI, D grade. DVY, C plus grade. SCHY, B plus grade. When an ETF has D grade momentum, those high dividends are just compensating for principal losses. Second warning sign. Consecutive dividend growth years. DVY, 4 years. SCHY, 3 years. V. PU, 3 years. JEPI, 0 years. No consecutive growth means the dividend isn't sustainable. Third warning sign. The 5-year performance. DVY 5-year return. 97.54% VPU, 5-year return. 65.02% JEPI 5-year return. 63.52%. Despite JEPI's massive yield, it underperformed the boring utility fund. Now, some people might say, what about SDY? It's from SPDR, yields only 2.52%. Harry looked at this too. SDY's 6-month return, 3.07%. Better than JEPI, but worse than DVY. The issue? SDY's dividend growth is slowing, only 2.02% over 3 years compared to DVY's 12.41%. When dividend growth stalls, total returns suffer. This proves the sweet spot isn't the highest yield or the lowest. It's finding the optimal combination of yield, growth, and appreciation. So what do you actually do with this information? First, audit your current dividend holdings. Calculate total return, not just yield. If your high-yield ETF has negative price performance, you're in the trap. Second, check dividend growth rates. Use the 5-year number, not 1 year. Consistency matters more than single-year spikes. Third, evaluate expense ratios. Every basis point matters when compounded over decades. SCHY at 0.08% versus JEPI at 0.35% is thousands of dollars over time. Fourth, consider global diversification. SCHY's international exposure provided the highest returns in Harry's portfolio. Fifth, don't abandon utilities. Boring equals stable. VPU's 20-year payment history means reliability. Here's the truth about financial independence. It's not built on current income. It's built on growing income. The dividend aristocrats didn't become aristocrats by maintaining high yields. They became aristocrats by growing their dividends for 25-plus consecutive years while appreciating in value. Think about compound interest differently. It's not just your money compounding, it's your income stream compounding too. A 3% yield growing at 10% annually becomes a 7.7% yield on cost in 10 years. Plus, you likely doubled your principal. An 8% yield declining at 4% annually becomes a 5.3% yield in 10 years, with potentially no principal growth. Which would you rather own? The $100,000 mistake isn't picking the wrong ETF. It's believing that passive income comes from high yield alone. Real wealth comes from companies that can afford to grow their dividends because their businesses are growing too. Harry learned this lesson without losing money. Most people learn it after they do. Those forums pushing JEPI for its 8.42% yield? They're solving for today's income, not tomorrow's wealth. The question isn't what yields the most today. The question is, what will create the most wealth over my investing lifetime? Because here's the final truth about investment portfolio construction. The best time to switch from yield chasing to total return isn't after you've lost money. It's right now. Before the trap springs shut. Harry's $250,000 decision saved him from a 6-figure mistake. Your decision today could be worth even more. The math doesn't lie. The data is clear. The only question left is what you'll do with it.